don't like releasing anything till it's fully done for a class, but at least you guys are finished. So I might as well at least have shared your grades to you. They're all posted on Brightspace. You will check the grade area, you will see how you're doing, and whatnot. A bit of our standard academic policy for a few years now, we do not give you your paper back. Because it's just too easy for everybody to snap pictures of it, and then it's not that we do the same questions all over again or anything, but some of them are similar. Like, there's only so many ways I can do a break-even question, and despite the fact you might have thought otherwise when we did it. Point is there's a lot of duplicate or similar, so we don't give it back to you now ever. Okay. However, what I am going to be emailing to you, and if it wasn't for the fact Mom got discharged from the hospital right literally before class, it would have happened already, so my apologies, but you will get it later today. I email you a detailed grade sheet that says how did you do on each question, how did it come up with your mark, and comments and things where you went right, where you went wrong. Actually, frankly, I'll be honest, it's usually where you went wrong, because most students don't care. If they got it right, they're just happy. But where you went wrong, I comment. They give you some ideas so that you can maybe learn from it or so. Okay, so that's going to hit your inbox later this afternoon once I'm done class. And the other class after. But sometime this evening, this late afternoon, you will get an email with your detailed grade breakdown. If you do wish to look at your test so that you can see what the heck I'm talking about and everything on the grade sheet, you can book an appointment with me. Come into my office or so, we look at the paper, I show you, describe it further, whichever. I've only ever had a few, believe it or not, less than 10 students in 1.5 semesters that ever really wanted to see it. But if you do, just book an appointment, we will make time. Okay? So, you read the other interesting stuff and everything here. The class average was 85%. The median, not sure how familiar you are with statistics, but there's a couple of ways you can measure averages. The average is the normal method where you just add up all the marks and divide by the number of students. But the median says half the students are above this mark, half are below it. Another way of describing average. So it's a whopping 91%. Half the class is in the stratosphere here. Okay? Quartile 3 is the top 25%. Like the top 20, not 25%, but the top 25 students are above 97. Q1 is the bottom, I'm saying 25, I mean 25% of the class, okay? The bottom 25% of the class is below 75. SAS Polytech says tests should be set for an average of about 68%. So I was too nice on you. I don't think you're complaining. But anyway, 80% of the class is in A or B zone. No failures. 3 perfect papers, 4 near perfect. And by near perfect, that means it's off by half a mark, like 32.5 out of 33, or 32 out of 33. It basically just means one little thing went haywire. So that's also unheard of on the exam. Not impossible, but I'm just saying. That number of students on a class of 25 or so is unheard of. So I was too nice on it. Guess I should have put the financial statement question in, and that would have evened it out a bit. How many of you would have just taken the hit on the financial statement question and did everything else? Anyway, humor aside, that would have been the harder part. This is normally where I also give you highlights of what worked, what didn't work for various students on the tests or anything like that. And not having the grade sheets in your hand yet, this is throwing me off the game a bit. because I can go through all that, but it's a lot more meaningful to you for you to have read them first. When I'm commenting on something, you'll understand what the comments meant if you didn't understand them in the first place. So if I may beg further forgiveness from you, perhaps we will do that Monday. In our Monday's class, you'll have your sheets by then, and I can give you the more detailed highlight of here's what I was looking for, here's the trick, here's where it is. Generally where the class, as a whole, individually, you might be different, but I'll just cover the main highlights. Anyway, I'm not unhappy with the result. It's a little too good. But I am going to say, generally speaking, I'm still going to maintain this, that the final exam is probably the easier of the two exams. Generally speaking. Keep in mind, I'm saying that because I normally have a financial statement question in theirs. But anyway, we'll see. I don't want to lull you into any false sense of security. When we did winter exam and everything like that in similar style, other than the fact they had the financial statement question, the results were not this good. So as much as, of course, we walk in thinking you guys are all idiots and don't know what you're doing, and the last class was a stellar one, and now I got all these morons, I think that isn't the case. You guys did pretty darn good here. If you were worrying, you really upped your game. And most people that had low marks from the first test, I don't know if that scared you, or it usually does. Students are going, oh my God, I just got 25%, or whatever. The game rose considerably here. So keep doing what you're doing, and life will probably be doing fairly well. And primarily, out of this group, those are probably the students that are actually reading the book. Keep doing that. I'm only going to caution, just remember, it is a second year accounting majors textbook. So it's going into far more depth than you need to. But some of you are reading it and picking up on that depth. Kudos to you. That's fantastic. In fact, some of you, we might try to kidnap you and put you into our postgraduate accountancy program if you keep doing this. Because some of you are interpreting things better than some second-year accounting majors would. So keep up that good work for those of you that are doing it. If this exam worked out better for you than before, keep doing what you're doing. Okay? On a somewhat related note, we'll probably have our budget test, the quick quiz, just dealing with budget stuff. In a perfect world, I really would have wanted to do it today, but that was just happening too fast. So I'm probably going to do it for next Friday, just because that's just a good day. I got both groups on the same day. We can just deal with this. It will be only a 1-hour quiz. It's only meant to be short. It's only going to have 2 questions on it. Basically, you're doing a budget and then another budget. The average time, as much as I'm saying it's an hour, in the past, those that knew what they were doing were done in 20 minutes. Those that more or less knew what they were doing were done in 30 to 40. So it probably won't even take the full hour. So likely what I'll do next Friday is we'll probably be carrying on with a bit of class lecture, so then we'll write the test and whatnot. And that'll be a pretty quick mark turnaround. Because most of the backlog of anything I've got is going to be finished by then. And number 2, it's a fast mark. So I'll probably have it done pretty quick order. And then that's also a good practice test for the final exam. That's kind of how you see budgets appearing in there. It'll be similar style of what to expect on the final. Can't make budgets that difficult either. Well, I could, but not we already said we're trying to keep it simple for you, so when you're doing that, it can't make it much harder. So, on that particular note, the main goal today is to really dive into our second last learning outcome. This one, if you're reading the book, is going to be a bit scary. Maybe, I don't mean that to mean that it'll be too bad, but it's the book, the chapter 10 that it's based on, is going to go into far, 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 far more depth than we want you to go into it. They're going to teach you about 4 or 5 different angles for how to do long-term planning. And in doing the long-term planning with this here, let me just get the slide up. We're dealing with capital budgeting decisions. What we mean by this is all the budget work you just finished was really meant to be short-term. It's like for the current year, few months, maybe next year, but not much beyond that. So this is now you're trying to make the decisions about, should I build a factory that I need to have operating for 40 years? Or should I undertake this project to build a bridge or something? It's those kinds of decisions. So it's something with a lot of money tied up and a lot of time. And it's sort of looking at a high level, what would I do? So here's the bit of the situation, as I describe it. The senior management in your company is sitting around with a problem. They have $5 million in the bank, and they don't know what to do with it. How many of you can think of all kinds of things to do with $5 million? Anyway, point being is, what I mean by it's not that they can't think of things to do with it. They're trying to make decisions on what projects do I want to invest in this company. So they'll say, well, we have shareholders that own the company. They are giving us money. Maybe some of this $5 million is money that the shareholders paid for shares even. And they're basically asking a big question. The shareholder wants a rate of return. They invest in this company because they think we can produce a 20% rate of return, a 10% rate of return, 5, whatever the number is. There's an expectation of profit here. So when I'm saying that the senior management doesn't know what to do with it, what they're trying to say is, well, let's pretend you are all part of the project teams and things like that in the company. They're going to call you into a room and say, who's got a really good idea for something that we can do that gives the rate of return that we want? And so every one of you is going to prepare a business case of here's what my team is going to do. We are going to build a bridge. We're going to do this. We're going to make a Cabbage Patch Kid and sell it to somebody, a Rubik's Cube, or it doesn't matter what it is. You've got an idea, and you're basically saying, I need $1 million to do it, or I need $2 million to do it. And they're trying to figure out how to cut up this $5 million, and out of all your projects, figure out which ones I'm going to do. So the whole point of capital budgeting here is, how do I go about picking it from a financial angle? Okay, the usual thing, there could be some other reasons for doing something, but this we're primarily going to focus on financial. So that's our problem situation. How do I pick which investments I'm going to put this $5 million towards? Because if I pick wrong, the shareholders are going to kill me. Okay? And in some countries around the world, that's literal. So, anyway. So the first major catch here that I have to get your head around with this is the basic idea of time value of money. We often describe this, or it feels like we're describing it in context of interest earned. That's a common one in banking. But I really want to impress upon you, this isn't a banking situation. When I'm saying value here, I'm talking about that expectation of a return. I give you $1 million, and by next year I want to know that I have earned $100,000. So that you've taken my $1 million, you've put it into a project that is creating $100,000 of extra income that presumably you are paying out to me as a dividend, if I was a shareholder.
So the interest here will be the bank interest or the government bond interest?
Yeah, I believe I did hear you, of course, but if I think I heard you right, I'm agreeing. But go ahead, say it again.
Yeah, because the interest you mentioned is the banking interest or the government bond is the zero risk.
Yeah. So to a banking situation, of course that's what they're doing. They're investing it. They pay $100,000. They say they're giving you a 10% rate of return. But in a business, it's not like there may be a guarantee of this. The investor's investing in the company because it looks like they can generate a 10% rate of return to the investor. So this is how investors look at it. They're trying to decide, do I put money in a bank? Do I invest it in a company? And that's actually one of the reasons in the global economy right now with what they're trying to do to bring the inflation down. Inflation happens for all kinds of reasons. One of the main reasons is overabundance of demand of product. So what they're doing by raising interest rates is they're making it more attractive for you to put money in the bank. Even if the rate's still lower, you're going to get paid no matter what. Whereas with companies here, it's a crapshoot. You might get money, you might not. So if that's more attractive, then there's less money going into businesses. Less money going into businesses, the demand stops. You have less companies putting strain on the supply chain, et cetera, et cetera, et cetera. Is it going to work? Don't know. It's going to be rough for the next year or two, no matter what happens. But we'll see. Anyway, so the catch here is $1 in my hand today is worth more than $1 a year from now because I'm expecting to have my rate of return added to it. So if I said to you, give me $100 right now, and at the end of the year I can give you $10 plus your 100 back, 10% rate of return. If I say give me the 1,000 today, and I'm going to give you $2,000 back in 5 years' time, is that a better deal? Well, the dollar's doubled, but is it a better deal? Don't know. So we need to come up with a tool that allows us to compare this. And so the essence of it, the 5-year example, is we would be saying, okay, I'm not going to get money next year, I am going to get it in 5 years' time. So what would a 10% rate of return per year have been to produce that extra 1,000 compared to what I'm investing now? And we try to take it back to what would I get right this minute if I could. If I give you $100 right now, what would not even in a year's time, what would that $10 be worth if you turned right around and gave me that income back right now? It won't be 10%, it'll be 1/12 of that, okay, roughly. Or 1/365th of it, depending how you want to do the calculation. But that's what we will do with the same idea with the 5-year investment. And we need a technique for doing it. Now, I think I said when I did the rules for the exam, we are about to go into ugly math in theory. It's not that ugly, but ugly enough, okay? And I promised you, and I still promise you, that we're going to make it relatively easy on you. So for doing the exams for this, you only need a calculator that can do the 4 basic functions: adding, multiplying, subtracting, and dividing. The ugly math, which requires logarithmic keys and exponents and square roots and all kinds of stuff like that, we are going to simplify it in such a way that you don't need all that functionality. I will show you in a moment. But that's the premise. This is the premise of what we're doing. We're trying to take all this future-oriented cash flow and bring it back to what's it worth today. So let's get an example in front of you here and we can talk through it. We are running a hospital. An American textbook, it's been Canadianized. But the distinction here that's important is, many hospitals, not all, but many in the United States are for-profit companies. Canada, not so much. So this will be a little bit of a strange example in the Canadian context, but believe it or not, it's no different whether you're a for-profit or not-for-profit. This is still about how am I making use of money. So we would still apply it here. So we've got an X-ray machine. There is an attachment that we can add on to our X-ray machine. It costs $3,170 to buy. Coming from the healthcare sector, I'm laughing uproariously about this, because that would be like you adding mustard to a hot dog or something compared to $3,000 on an X-ray machine. Can't be a very significant attachment. A funny for you on this for Friday afternoon, our surgeon at our hospital bought, I want to say a Lamborghini, but I'm not sure it was a Lamborghini, but it was one of the really cool sports cars. 0 to too fast in like 2 seconds kind of thing. He brought it in, drove it into the parking lot, parked it in the doctor's spot, and we were all getting out there and taking pictures for the newsletter showing off the guy's new car. Meanwhile, I had just bought a mobile X-ray machine that could be moved around room to room and snap people's images right wherever instead of hauling them off. And I said, quick, wheel the thing out, put it side by side, and we can have a contest here in the hospital. Which cost more, the car or the X-ray machine? You know where this is going. His car was like about $130,000 to buy. The X-ray machine was $160,000, and it looks like basically some sort of one of those floor washer things, except it had a boom or two on it. Anyway, $160,000. So believe me, $3,000 doesn't go very far on an X-ray machine. Anyway, neither here nor there. Costs $3,170. Will work for 4 years, and then you have to replace them. Like it'll wear out and you need a new one. We're not going to be able to sell it for anything. And in putting this gadget on, we will increase cash flow. If this is a not-for-profit, it would be we are saving cost of $1,000 a year. The hospital here wants to have an annual return of at least 10% on any decision it makes. Now again, this is a bit of an iffy thing because we're talking healthcare. So is this all about money, or is this thing going to do better health outcomes? You don't go pitch it to the public in Canada about saying, oh, we're just trying to save 10%. Yes, thank you for looking after my budget dollar, but is this really helping a patient? That's really what we would say to Canada. Anyway, $3,000 cost, $1,000 a year, money saved over 40 years, and we want a 10% return. Should we do this? Anybody want to guess right now? You know how the textbook works. If it sounds like you shouldn't do it, you probably should, and, blah, blah, blah. But any first opinions?
So we need to...
You can be wrong.
So you need to calculate the present value of the 1,000.
You're getting ahead of me, which is a fancy way of saying hurry up and get there, right, for me. But yes, you're right. We have to do that. That's exactly going to be the next step. So simple math, 4 years times 1,000 is $4,000. This is 3,000. So this should all work out. We're ahead, right? And of course, well, we will see. So here's how we do this. This needs some explanation for those that haven't done it. But don't look down here for a moment, okay? I will get to there. We are spending $3,170 now. So we put brackets around it, that's money out. Any money going out has brackets around it in these problems. Just trying to make this a little more readable for you, okay? So we are out of pocket $3,170 right as soon as we buy this piece of equipment. we are going to get $1,000 every year for 4 years. If you want to spend a ton of time on the exam of manually calculating what that would mean at a 10% rate or something like that, you could. You'll probably get it wrong. Look at the first year right, but second, third, fourth year, that's questionable. Okay? So this is where we made the math easy. We have a table down here. There's actually 2 tables. We're only looking at one of them right now. I really hate that screen problem. Let's try that. This thing. Anyway, we will give you a table in the exam that basically looks like this. And what you do is you find the rate of return across the top that you want, count the number of years that's happening, and find where they intersect. And then you take this number and multiply whatever the cash inflow is, the cash outflow, whatever it is, multiply it by that number. And in this case, what it's saying is $1,000 over 4 years, every year, $1,000 coming in over 4 years, at a 10% rate of return. That's the equivalent of $3,170 right now. That's what it's worth right now. And if you don't believe me, take $3,170, multiply it by 10%, add that to it, subtract $1,000 off for the payout for the first year. Take whatever's left, times it by 10, add that to it, subtract another $1,000 off for the second year, do the same thing for the third year, and by the time you're done the 4th year, you should be at 0. If you're done. Half of you will say, it's okay, I'll take it on faith. If this is what I'm supposed to do for the test, that's all I need to know. Okay? Fair enough. $1,000 a year for over 4 years, at 10% rate of return is worth $3,170 right now. So, you've looked at this now. The present value here of all the money coming in versus all the money going out worked out to 0. Bet you didn't see that coming. Should we do this?
It depends.
And sorry?
Actually, it depends on the business context. If they really need the investment, because like there is other profits or the growth, they should. Because the difference between the annual cash flow and the investment is 0. It's not like
That's right.
It's not too
If
favorable
we were
for the
comparing
company.
this to a bank investment, which I'm not sure if it was where you were going with it, but if we were comparing this, we would be saying, what money am I putting out now versus what are they saying they're going to pay us? You do the same thing, and if it came up with 0, if it came up with better than 0, we would probably pick the other thing. If it came out less than 0 compared to this, that would be bad comparatively. But the real question, the first question is, should we do this?
Yes,
And why?
because it's incur no loss.
I'm grinning, by the way. Why should we do it? Sorry?
Because it's incur no loss.
That's right. Exactly right. This 0 isn't meaning we've broken even. What it's meaning is we are getting our 10% rate of return. So if it's 0 or higher, very good thing to do. Cutting to the chase, if all of you are writing a business case, the bosses are probably going to say, thou must do this in part of your business case. And they're going to take all your projects, they're going to put them in a pile, ranked from which number's got the highest one of these, and that's what gets the priority of the $5 million from the start of the class. And then after they funded the first project, they'll go down and say, now what was the next one? And then they'll keep doing that till they've allocated $5 million. So, question for you. What if this is a negative? Particularly small negative? What do you mean no? Okay, if it's a small negative, actually even a big negative, okay, and you have nothing else to do, and you got $5 million, all it means, if it's a negative, is you're not getting your 10% rate of return. Now, I can't remember, I probably blew my delivery with this, because I think I told the other class this part as a lead-in before I got to this slide, so I got to backpedal for a minute. In almost every religious text around the world, there is a story in there. Names change, details are slightly different, but it's the same basic notion. Usually a father, most of these books for some reason were written by men, so it's always the guy, but anyway, the father gives his kids some money. And it's go out and do something with it. And basically 3 things happen in the story. The first kid hoards it, protects it, does nothing with it. But at least they have the money a year or 2 or 3 later. Some other kid does all kinds of reckless things with it, wastes the money and whatnot. And then the third option, and the point of the whole story, is along the line of somebody else did some prudent work with it, made the money grow, looked after their community, whatever outcome in your particular story, or however you've heard it. This is the theory of this. So if I have $5 million and all of you come up with all kinds of useless plans that don't generate a 10% return, are they going to sit around and not do something with the $5 million? Well, they're not going to get any rate of return for their owners if they do nothing with it, other than whatever bank interest they could get. So they will consider a negative project, especially if it's close to 0, because maybe getting a 9% rate of return is better than no return. And it's certainly better than a bank will pay right now. By the end of the year, that might be a different story. But right now, 9% is better than what a bank can do. So it wouldn't be your first choice, but if there's no other better choice, then you could consider it. Now, why do I make a point of this for managerial wisdom? Because that could have an impact on projects and things that you do. The other reason is it's a darn good question to have on a test or an exam to see who's really thinking outside the box or who's memorizing things literally. So don't just immediately dismiss it because it's negative. That doesn't mean rush out to do it. I'm just saying understand it just simply means you're not getting your desired rate of return. There might be other things we need to consider too. For example, on the $5 million, I have no better project to do. If this negative thing is going to tie up that $5 million for 400 years, I might decide maybe I will wait a year to see if something better comes along. Because it might tie up too much money for too long and I'm not getting my rate of return. But if it was something like this is a 1 or 2 year investment for the $5 million and it's going to get 9.5%, okay. So anyway, that's how this works. So there's a second table that's not showing in this one. But this is if I'm getting a payment happening every year, hence the 1 to 4 years. I could also be getting a lump sum payment or having to make one at the very end or at the beginning or in the middle or something. And then it uses a different table, but it's the same idea. You still go and look up the rate, the number of years that things happening, but it will have a different factor. Basically, things that happen every year, like $1,000 a year or something like that, every number here will be greater than 1, except for the first year. If it's a one-time payment that's happening, it will be less than 1 on the table by the math of how that all works. We'll see examples coming up shortly. So on that particular note here, this X-ray machine, the slide's now catching up here, we could consider doing it because we're getting a 10% rate of return happening. This is a neat slide to have. There's one breath I want to skip over, but it's a neat slide to have nonetheless. It basically says, what are examples of cash flows, cash outflows, cash inflows? So money going out is often the initial investment. You can predict this in every question we are doing. You will see a cash outflow happen at the beginning. If I'm increasing working capital, that's an outflow. And some of you might go, what is that? What does it mean? Well, working capital is, here's money I have in the bank. It's meant to pay the day-to-day bills of whatever my project is. So for those of you that have ever worked in a restaurant or a store or something like that, you know the cash register has a float? That's working capital. It's there to do the day-to-day stuff. So why is it an outflow? I've got the money. You do, but can you use it? So if you think about it, if you were a store owner, I have $50 in my cash register. Can I just grab that $50 and use it for something? Well, yes, you could, but now I have no float. Now somebody needs change. It'll be like me getting lunch at Tim Hortons, where I was, after getting mom home from the hospital, I'm running to get here and I've had no lunch, so I'm a grumpy bear right now, and all that kind of stuff. I go into Tim's, get all ready to order something fast so I can wolf down while driving. Please don't do that. But anyway, and all of a sudden it says our electronic systems are down, can only do cash. I haven't carried cash for 30 years, but a lot of years. So it's like, it would be no different. I don't have the cash, now I can't buy lunch. So the point is I've tied up the money. I still have it as an asset, but I can't use it for any other purpose. So setting aside money for a project, we consider it to be an outflow. Repairs and maintenance costs to maintain the equipment is an outflow. Operating costs, like if we're building a factory and making something, all the costs to run the factory is an outflow. Think of it as the cost of goods sold and all the regular expenses. This isn't something new. We're just saying that's an outflow if I'm planning this. And whatnot. So typical inflows, all the money we make, that's an obvious one. If we reduce costs, that becomes an inflow. You could also do it by just reducing the cost and using a different thing too, but sometimes if you're doing something that is saving a cost, you will treat that as an inflow. Very popular in government ways of doing stuff. The salvage value of our factory equipment or whatever. So salvage value, for those of you that didn't figure that out on the test, or I didn't answer it, or something that was happening, salvage value is what you get paid for the equipment or the building or whatever after you're done with it. So I could buy my X-ray machine at $160,000 per the previous story. At the end of 10 years, that thing's probably worth maybe $2,000. So that would be my salvage value. And then this is the one you're going to get wrong on the exam. Now that I've finished my project, this money up here that I set aside, I get to free it up and use it elsewhere. So you will forget that now that I'm wrapped up that project, the money that was just paying for the day-to-day things in and out, that float I get to take out and repurpose it. So at the very end, it becomes an inflow too. It was an outflow when we set it aside at the start. Now it's going to be an inflow at the end. So those are very common examples. Pretty much almost anything you're going to get on your final exam question is going to be one of these things. I could make it harder than that, but I'm not going to. What? After the stats I was showing up there, you guys need a challenge.
No.
You know, some of you are up at snuff with accounting majors for this. I should probably give you some of their types of questions or something. But no, come on, you guys are up to it.
You can wait
Anyway.
for them, but not us.
I did this wrong. If I was going to make it hard, you make the midterm hard. Because then what happens is half of you drop the course, and then I have less marking for the rest of the semester. I'm really not thinking smartly here, am I? Anyway, it's all about me. Anyway, here's a more realistic example of a question. Lester Company has been offered a 5-year contract to make a part for a large manufacturer. Very real world. All of you are going to be employed in a situation where this could be a very common decision that has to be looked at. So here's details. We're going to have to buy $160,000 of special equipment to make this thing. We need to set aside $100,000 for the 5 years to run this part operation. At year 3, we need to do some improvement, like major repairs to the equipment or something. If this was doing something like in manufacturing or farming, an example would be is if there was something like blades for cutting up wood or something in it, you're probably going to replace the blades by year 3. You know, that kind of stuff. At the end of 5 years, we'll get $5,000 for this. $160,000 piece of equipment plus $30,000 of relining. We will get $5,000 for the whole package at the end of 5 years.
Teacher, what does it mean by relining?
Sorry?
What does it mean by relining? Relining equipment, what does it mean?
Sorry. That helping? No.
The relining equipment, what does it
Yeah,
mean?
they didn't describe, but what they're meaning is they're doing some major repair to the equipment. Think of it that way. They didn't describe what it was, so we don't know, but I just know
It's
enough.
like maintenance cost?
This is a major repair. This is just something where they've got to replace some components at year 3. That's what they're meaning. Annual cash revenue and costs. We will get $750,000 every year from the sales. So this is what our manufacturers pay us. They will pay us $750,000 to provide parts every year. It's going to cost us $400,000 to make the parts, and we got to pay people, so that's going to be $270,000 a year. Very real type of problem. Should we take on this contract?
No whistling in the cell block. You feel that's rude, you're getting correction.
I'm hearing that.
It's a signal, buddy.
So, should we do this? Still leave it ajar if everybody's got something. Everybody restart a block next to the sound stuff. So, what we're going to do, very much like that X-ray machine, is we're going to grab every line here and go do the same thing and see what the ramifications would be. And again, they want a 10% rate of return, just so we know what we're comparing it to. So we can do a shortcut here. I'm totally fine on an exam if you do it the long way. But if you want to save a step, we can take all the annual things and mush them together and come up with the net effect. So the bottom line here is $750,000 revenue, $270 for costs. We are getting $80,000 a year positive cash flow. Okay, So we can just use the 80,000 here for our purposes. You could do each line separately. So here's how this begins to look. We gotta buy a $160,000 piece of equipment right now to do this project. We have to set aside $100,000 of cash to be paying the bills for the 5-year period here. So we are out of pocket 160 and 100,000. Keep in mind, we still have this, it's just we can't use it for other purposes, so it might as well have been spent. And then we've got the annual cash inflows for 5 years of $80,000. So for 5 years, 10%, that's got a factor of 3.791. How did we come up with that? Again, the table that they didn't show you, you would look at and you go, where's the 10% column? I count down 5 years and I grab the number. Now, I keep forgetting the page number in the book, but it is in chapter 10. You will find this. I want to say it's table 14 point something, but I don't have the book in front of me. But anyway, it's in your book. I am going to give you the table in the exam. Okay? So you will have any table here you need to look up. So anyway, 10%, 5 years, where does it intersect? It intersects at a value of 3.791. So I take 80,000, multiply it by that. In today's dollars, the annual inflows were $303,280. Now, at the moment, things are looking very good for our project. Because once I've done that, you'll notice 303 is bigger than 260. So we set aside that money. I'm doing so far so good. I'm ahead of the game. But you'll notice there's blank space. Year 3 comes along. I need to do that repair. It will cost $30,000 to do that repair. And I go to the other table. I go look, find the 10% rate. I look down to year 3 this time. That's got a factor of 0.751. That means in today's dollars, that $30,000 is worth $22,530. If I was going to do the repair today, that's what it should cost.
So wait, what a table? It's a different number.
Maybe it was a different number.
Is it?
Well, it would, because this table is only used for multiple year ones, like the annual cash flow, something that's a payment every year. That's the table for money for things that happen every year. So if it only happens once, like this lining does, only in year 3, there's a second table you have to look at.
So the question will be this
Yeah.
another table.
Yeah. Now, the interesting irony, Greg's got my textbook. When he originally was going to teach you, he said, I need a textbook. And I said, you can steal mine. He stole mine. Now I have no textbook. Never lend your textbook to people. Okay? This is an inside joke. I'll get it back. But I'm just saying my textbook where I could flip it, look it up where the table is, Greg's got it. So I have an e-book, but it'll take me forever on the e-book to find it. Okay? But there's 2 tables. One that handles payments every year, and another one that's one-time payments that happen. And the art here is knowing which table to use. So if it's only affecting 1 year, like in year 3, you use the table that's only for a lump sum amount that happens. And how can you recognize it? Every value will be less than 1 in the table. The multiple year one, the value is always greater than 1. So if you see a factor that's like 3 point something, 5 point something, 6 point something, whatever, that's for payments that happen every year in the table. In other words, the present value of an annuity is the technical name for it. Then we have the salvage value at the end. We're going to get $5,000 at the end of our 5 years. What's that worth in today's dollars? We look up in the lump sum table, 10%, 5 year, it will have this factor. Multiply that through, it's worth $3,105 today. That's equivalent dollars in today's money, if I want a 10% return. And then lastly, we free up that $100,000 of working capital that we were set aside to pay all the bills. So remember I said it's an outflow up here, it's an inflow down here. But wait, aren't I getting my $100,000 back? Why is it only $62,000? Because yes, I'm going to get $100,000 back in 5 years, but while it's been sitting there doing nothing, I've been losing money on it. So in today's dollars, it's only going to be worth $62,000. Call this the cost of financing your operation. Anyway, the $100,000 will be worth $62,000 in today's money. Add all this up. If I got a positive number here, I'm getting my 10% rate of return. Go do the project.
You spend another 1.5 million.
Sorry, which? Never give the students the printouts. It is. It's the same thing. We set it aside at the beginning, at the minus 100. We get it back in 5 years' time, but it'll only be worth equivalent today of $62,000. The whole point of the exercise is saying, how would this work out if this was all literally happening today? So a lot of it is taking anything that's in the future, I gotta discount it back to what it's worth today. That's the hardest part of the chapter, getting your head around that part. Now, one of the other methods in chapter 10 that we are not studying would have taken this and said, okay, good, this is positive, but what rate of return is that? And it would have had you do all kinds of stuff to say, if I've got 85,000 left over here after 10%, I could do all kinds of fancy math, and I could calculate that it's an 18% return, or a 26% return, or whatever. The math's a little bit ugly, but conceptually, that's probably what you would want to know here. What is the rate of return that this is getting? And the good news is you don't need to know it for this course. So while I'm looking at somebody who I know will read the damn textbook, you can read it because you're interested, but I'm not testing you on it. Okay? I just know you'll read it. So anyway, so if any of the rest of you are reading stuff, you don't need to know how to calculate it to figure out, so what is that? What does this mean as a rate of return? All you need to be able to do is this. And then realize, back to what I started kind of the class with, if you were all pitching a project to the bosses, they're going to rank this stuff and say, which stuff's got the higher dollar value? And compared to what I got to invest. And that's the order that they will assign their $5 million for various projects. How am I doing on time? About an hour in. Okay. So related to this, and tying into what I just said a second ago, there is something called a profitability index. This is how they actually do the ranking. They will say, with this, I have two projects being compared side by side. Project A will generate $81,000 of cash, but it needs $80,000 of investment. Okay? So basically 81 divided by 80 comes up with a factor of 1.01. Project B, meanwhile, comes along. It will generate $6,000 of cash inflow with a $5,000 investment. Notice we get $1,000 either way out of these two projects. But because 6 divided by 5 works out to 120, they'll say project 2 is of greater interest to us because we get our $1,000 profit here with less investment. So what they'll do with this is they'll take the calculation you just had. Let me back up a slide for a second. They will take $85,950 here and divide it by $260,000. And they will come up with a profitability index. Then they're going to do that with the next project. And then they're going to put all these things side by side here. And whichever one is the highest number, that's the one that gets assigned their money out of the $5 million. So comparatively on this one, if there was $5 million, this project will be greenlit, $5,000 will be set aside for it, go do it. Now I got $4,995,000 still sitting there. I go on to the next project. And I keep doing that till I've allocated all $5 million of investment. So this is the piece of how they rank their projects. Here's the positive cash flow at 10% compared to the investment that we're going to do. They work out a profitability index here, and then they can rank the projects. That's what the senior people will do in your company. They'll take all 25 of your projects, proposals. They'll force you to do all this calculation stuff or whatever, and the ones that provide the best rate of return will get the priority. Now, can you have other things that influence the decision? Of course. Just realizing if you do something else with it, you are now, you're probably doing it with a financial impact issue. And generally speaking, you got to be careful doing stuff with that, so they'll be cautious. But other things that could be considered, the length of time the money is tied up. You know, basically generating the profits on something sooner is sometimes better than something longer term. Problem with longer term stuff is things can go really, really well or really, really badly over time. How is your investment in steel factories in eastern Ukraine right now playing out? Case in point. So you've got all kinds of things in here that over time can really disrupt things. So there's less risk if it's in shorter time frame. So that will sometimes win out. Even if the cash projection here is showing it's a better return, somebody might say this is going to tie up investments longer. And it's not that they won't do it, but they might be looking at this and saying, I need to, I want to make sure I'm not doing all of my projects long term. So take this to investment theory for a moment. What a stockbroker, like a portfolio manager will do, when they're setting up a mutual fund, they'll say, we want a certain amount of the equity in really good long-term, high-profit things. But then I want to have some of it in maybe lesser return, but shorter, time frame. And this is how they come up with their investment strategy that they market. You give me money to the mutual fund, I'm going to do so much in this sector, so much in this, so much in that, and it's to what comfortable level fits your investment portfolio. If you're near retirement, you don't want them taking risks. If you are young, you want them taking tons of risks. because, you know, even if something went bad, the next thing is gonna go really good. But you don't wanna be doing that with your grandparents' portfolio. So bottom line in this, that might be a factor that's taken into account as well. Yes, the project ranks better, but am I taking greater risk in doing it? See, there are other little things. Sometimes you should just do something without necessarily the bottom profitability. Sometimes you need to make an investment in infrastructure, even if at first it doesn't look like you're gonna make a ton of money with it. So case in point, let's say you're extracting ore from a mine somewhere in the jungle. How do you get the ore out of the jungle? I might need a road. So do you pay someone to build a road, or do you create a road building company and you build it yourself? Somebody might say, well, I'm not gonna do that road building company at loss, but its main purpose is to provide my own road so that I can get my ore out. So they might say, maybe I don't get my 10% rate of return on the road company, but maybe I'm only getting 8 or 9% or some such. But by doing it, I can guarantee that I'm gonna have a road. I don't have to, the road company doesn't have to say, well, we don't feel like building a road today, and, you know, to you, you're going, I own the road company, build the road, railroad, whatever. So sometimes if it's a necessary piece of infrastructure, you might be doing something at less of a rate of return, even a loss, but it makes possible a higher rate of return project to carry through. So that's, you know, you do get some things here where it makes financial sense, even if at first it doesn't appear to make financial sense. So this is the heavy method of chapter 10. This is 80% of chapter 10 covered today, one class. We're going to do some more of this come Friday. Sorry, this is Friday, come Monday, whatever. Anyways. There's one other piece of chapter 10, payback period. This is the only two things we're covering in chapter 10, net present value and payback period. I wasn't really planning on covering payback period today, but I probably can. Okay, internal rate of return, for those of you that printed out the slide deck, take out your pen and put an X through it. We are not doing it. But we are doing the payback. Okay? But I really wanted to do it. Anyway. Put an X through it. Okay. So what payback period is, let me give actually some first context. Net present value is the holy grail of what you should do. In accounting and finance terms, you do it. Okay? This is what we do. And essentially what then happens in this is the other exception. You shouldn't make decisions based on this. By the way, for those that are needing a break, I'm probably done in 5 minutes. I'm afraid I'll give you a bigger break. So rather than have you go in and come back and whatnot. All you do is take the total investment required and divide it by the annual cash inflow. No tables, no rates, don't care what the rate of return is supposed to be. If I'm getting $80,000 per the previous question and I invested $260,000, what's my payback period? $260,000 divided by 80, 2 years. They use different numbers here, but they're using an espresso bar. So they basically said, it's going to cost us $140,000 to build this thing. We will get $35,000 a year. How long does it take to get my $140,000 back? And the answer is 4 years. Do not make business decisions based on this. you will make less money. But where this is handy, and why we're teaching it here, is this is really good to explain to people that don't get into all the finance. You know, how you are getting a payback, how quickly will it take to get your money back. Especially in the short term, 1 to 2 years or so, it's a very good way of expressing it, especially if you have very low interest rates. So that's going out the door right now, but for the last 20 years, this would have actually been a very viable method, because interest rates were low enough that to some extent we didn't care about the time value of money. So anyway, quickly it just says, when am I getting my money back? And this is something that you would use with a negative net present value. Oh, we're not getting our rate of return, but I'm getting this back within 1.5 years. So I might as well make 8% quick here, but I'm going to have my cash back to put towards better investments within 1.5 years. Okay. You know, like if I was going to get 8%, but I'm tying up the money for 40 years, that's not desirable. But a quick 8%, maybe it is, if the payback is saying I'm getting it back quickly. So these are the only 2 methods that we're going to be covering in Chapter 10. A little more of the story here, but you need a break and whatnot, so I'm going to call it a day. On Monday's class, we'll go over some of the test things here, because you'll have your grade sheets back by then to see how you did in detail. And I'll go a little further into how we work a bit more with payback. But the good news is probably by next Friday, we've covered the 2 big components of the final exam. The budgeting stuff and Chapter 10's things. So it's really, next Friday, we'll probably be looking at doing the budget quiz, about an hour, half an hour to an hour is time to do it. And we'll be, the remaining week or so is just practicing stuff for the final exam.
So the final exam,
Some of
the
the,
chapter 7 and chapter 10.
Sorry, Rich?
So the final exam is 6 hours and chapter 7.
It's definitely going to be Chapter 7 and Chapter 10. The court is out how much of Chapter 11 and 12 are going to be on. We're still having discussions with the other instructors teaching in Prince Albert, just to see how much we need to know in there. They're ahead of us because they didn't have an instructor change. So she's covering it, but you know, at the same token, I can't rush material that you already know. So I'm course trading on it. We'll see how much we do. It might just be a small question or something, if I can get to it. I'll know next week how the time plays out. But Chapter 7 and this little bit of Chapter 10 is the bulk of the exam. Yes, sir.
Like for midterm, you uploaded questions on Excel.
Yes.
So for the same, you will be uploading for the same envelope.
Yeah, I'm going to do some practice videos in there. You were asking, can you submit them in Excel? But I'm still going to.
Like earlier you did for the midterm.
Sorry, Rich?
For the midterm, you uploaded certain questions on the Excel where you solved.
Yes,
Similarly,
yes,
you
I will
will
do that. When I get to, now that we're through almost the period, when we look at exams, I will do it in Excel and upload it. That's been the time-honored best way of doing it. So yes, when we do classroom questions on any of this, I'll do it in Excel and I'll upload the sheets. Okay, that's it for this week. I'll let you scoop. I'm going to admit I have a hidden agenda. The time in between now and the next class, I'm getting to watch the test mark for the other day. Anyway, but have a good weekend.
You will not have